If you're new to the idea of passive income, this concept continues to be attractive to everyone looking to build wealth. Let's face it, who wouldn't like the idea of sitting back and watching their extra cash generate more income without having to do additional work? However, this is easier said than done for most people. Passive income comes from legitimate opportunities with potential for substantial returns. That is where dividends come into play. In this video, I'll explain exactly how dividends work in simple terms. Now, while you might see hundreds of ways to generate passive income on the internet, a lot of them are not legit. If you stay until the end of this video, I'll tell you exactly what to watch out for when choosing high-paying dividend stocks. What exactly are dividends? Dividends are payments companies make to shareholders as a way of sharing profits. Investors earn a return on stock investments through dividends, which are paid on a regular basis. You should note, however, that not all stocks pay dividends. If you want to make a dividend investment, find dividend-paying stocks. Dividend stocks are probably the best definition of passive income. Why is that? Most passive income sources would still require you to do little work up front while you're at it. For example, rental properties would require you to maintain your properties, or else it would depreciate and become unappealing on the market. In a way, I could argue that it's semi-passive and not completely passive income. Great news! Dividend stocks aren't like that. In the current period of exceptionally low interest rates, dividend income is in a league of its own. It is possible without any effort to create a portfolio of stocks that generates a steady return of up to 4% per year. There is no better example of a truly passive investment today than that. Keep watching, because in a minute I'll tell you exactly which benefits you can expect as you become invested. To reach a substantial level of income takes a lot of capital and requires wise investment choices. However, you can earn as much as $1,000 in dividends once you make the right choices. And as soon as it's up and running, you'll have little or nothing to do while watching your dividend yield income. Why should I invest in dividends? Well, here are 3 important reasons you need to start sooner rather than later. Number 1. Capital appreciation. First on the list is capital appreciation. I mean, what's the point of investing in stocks if they don't rise? Dividend stocks are stocks after all, and the value of stocks tend to rise over a period of time. Let's use a popular stock as an example, which will be Pepsi. At the time of this video, the stock pays a dividend of almost 3% per year. The current share price is about $170, but if you purchased the stock 10 years ago, you could have done so at less than $65 per share. The stock value has almost tripled in 10 years, and you have earned 3% in passive income over that time. The fact that the dividend stocks have the advantage of not just providing a steady income, but also the cool benefit of capital appreciation. This can protect your investment from inflation and still make sure it rises in the long run. Number 2. Tax benefits. Dividend-paying stocks offer tax benefits in addition to yields on top of that. Dividends are treated as ordinary income by the IRS. However, if qualified for the long-term capital gains tax rate, you will not be getting taxed. Dividends on the stock must be issued by a U.S. corporation or by a foreign corporation with stock trading on a U.S. exchange in order to qualify as a qualified dividend. To qualify for dividends on a stock, you must also own it for up to 60 days. If you hold dividend stocks in qualified tax-deferred retirement plans, the tax benefits won't matter. Simply put, just by holding them in a taxable investment account will give you huge benefits in the long run. Number 3. Dividend stocks versus growth stocks. There's something you really need to know about dividend stocks. Contrary to popular belief, dividend stocks tend to rise less in prices. The reason is because, as the name implies, growth stocks are all about growth. Most pay little dividends, if any at all. All profits are instead reinvested into the business to expand revenue and profit. The point is, you won't get any income from the stock unless you decide to sell them, so you might want to hold a considerable number of them in your portfolio. Then and only then will the appreciation value come at that point. For now, though, it's just paper gain. Dividend stocks, on the other hand, generate consistent profits and don't need to be sold. Generally, investing in dividend stocks is considered a better way if you're looking to gain passive income. How do I make passive income through dividends? For starters, use dividend income as an investment. Reinvesting dividends is a good way to increase your passive income. Instead of just earning dividends, you can use them to purchase additional stock. Increasing your exposure to the companies you've chosen means you would have a higher income potential than before. Reinvesting for a number of years can double your passive income generation. You must keep in mind, though, that investments always come with risks. This means you also stand a chance of losing your extra income. Be patient, time is on your side. At times, investments initially seem to be weak. Still, the stock price should increase over time. If you've done proper research and invested in the right companies with solid foundations, they will find success, resulting in stock growth. Also, since your stock purchase price is a fixed cost in the past, you tend to benefit more over time. This means that holding on to stock for longer periods of time gives you more opportunities to gain dividends. For you to make passive income, a profitable company's stock price doesn't necessarily have to skyrocket. It simply has to keep passing along profits to its shareholders. Only make calculated risks. While dividends are a very good means of passive income stream, there's still a chance of failure. Like any other investment in stocks and other assets, there's a chance your dividend holdings will not yield profits or dividends. Specifically, one or more of the companies you invest in may experience years of stagnation or go out of business. The risks involved are why diversification is essential to maximize dividend yield. In this context, I'll advise you to diversify on two levels: in your investment portfolio and in your passive income streams. Even though you can eliminate risk entirely, you should always try to reduce it. As the saying goes, don't put all your eggs in one basket. Instead, thoroughly researched investments among a variety of assets and opportunities will provide more reliable returns. Where do I find dividend stocks? Dividend-paying stocks are typically issued by large corporations with established financial records. Think of companies like Apple and Johnson & Johnson, or at least companies that consistently pay higher yields over time. They are also commonly known in most cases. They probably have popular products and services, or they've been around for a long time and have built a strong reputation. They are usually well known by investors too. Due to all those qualities and their dividends, when it comes to dividend stocks, companies can choose between different dividend types. Some of these types include: first, cash dividends. These are the most common type of dividends. Most companies usually deposit cash dividends directly into shareholders' brokerage accounts. Second, special dividends. Shareholders receive these dividends when their stock rises in value, but they do not recur. When a company has accumulated profits over years but does not need them at the moment, it will issue a special dividend to shareholders. Number 3, stock dividends. Apart from paying cash, companies can also share additional stock with investors. Fourth, dividend reinvestment programs. With DRIPs, dividends are not directly issued but are reinvested into the company's stock, often at a discount, so investors receive their dividends back sooner. Number 5, preferred dividends. These are dividends paid to the owners of preferred stock. Preferred stock tend to function less like stocks and more like bonds. Most preferred stock dividends are paid quarterly, but unlike dividends on common stock, they're usually fixed. Dividend stocks aren't typically met with the same buzz as growth stocks do. The thing is, they're the kind of investments that can build permanent wealth and generate passive income. For retirement portfolios, dividend stocks are particularly enticing. Investing in these funds will not only allow you to build wealth over time, but will also provide a consistent flow of income when you retire. As the stock prices keep rising in value over time, you can use the dividend income to cover living expenses. If you found this video helpful, be sure to hit the like button so it can be spread to more people.